Okay, third time trying to record this is the charm. So this is in response to a buddy of mine in a private Slack group who posted a video, and what the video's argument was that in order to find where Bitcoin is going to drop to, then you have to find what the analyst was calling the fair market value. And the way he defined that was to look at where there had been periods of consolidation in the past. And he picked this one right here, which was about 2 weeks. And he said, okay, that's a fair market value, but the problem with that is that it wasn't long enough. There wasn't enough. The consolidation didn't last long enough in time in order to count. So then he went back a little bit further, and then he said, oh, well, we've got this area here, which kind of oscillated between 3 and 5,000, so call it 4, split the difference. And that was a 2-month period, and that was better. The problem with this kind of analysis, there's a couple problems with it, but the main problem with it is that it is 100% completely subjective. So why is this okay and this okay, even though the percentage difference here is almost 100%? Let's look at a log chart. This is a log chart, actually. Yeah, it looks, his case looks more convincing here. You can see it here and there. You can say that, oh, well, it looks pretty consolidated, so that must mean that people agreed, which isn't really what consolidation means. But when we look at it on a log chart, we can see that, well, the low in this here was 3,600. The high up here was just a hair under 5,000. So from 3,600 to 5,000, that's a 50% range from the low. So that's not consolidation really at all. It just looks that way because when you look on a linear chart, because the Bitcoin blew up so much that it looks relatively flat. But why is it that, and why is it not this thing over here, or this part over here, or how about this part over here? So this was about 2 months also, and it had a similar kind of, actually had a tighter range. It went from 6,700 down to 5,500, so that was a 1,200 range on a higher starting point. So the percentage change was lower. So it's just complete cherry picking, and that's the problem with this kind of analysis. It's the same thing where Elliott wave people are just talking out of their ass because they're picking things post hoc and making it fit their own narrative. So it's just not a reliable way to do technical analysis. So when you're doing technical analysis, and I'll try to keep this brief, what you're looking for is patterns in psychology, because there's really just buying and selling, and when it happened and how much of it was there. So it's it's not rocket science. You're just trying to anticipate where other people are going to go, and it's sort of an arms race because the other people are trying to out anticipate you, and you have to do go beyond them, and so forth and so on. Millions of market participants are all trying to do the same thing. So here's what I see when I look at this chart, and let's see if I can bring up some drawing tools here. We have this range here. Oh, that's not what I wanted. There we go. So that's close enough. So we have this support range where we've bounced 1, 2, 3, and now we're at a 4th time. And then we have this over here. Okay, so what we are seeing here is that at roughly the same price, buyers have stepped into the market, and the money coming in has been greater than the money flowing out, and so prices have risen. At those points, and then the points where we have turned around the other way, the money going out has been greater than the money coming in, which causes the price to fall, and so that's what creates a turnaround. when those trends change. But the important part here is that the point at which the sellers have taken control of the market has been sooner and sooner and sooner into these rallies, in terms of price. So, people have been giving up hope earlier and earlier, basically. And that does not bode well for, this right here, because we're at that support line here. So typically, when you have a wedge pattern, which is what this is, whichever side is sloped is going to be the one that wins. Because if it were going the other way, we would say the buyers are coming in, earlier and earlier into declines, and so they're becoming stronger and stronger, more confident. Here we're seeing the sellers becoming more confident as they're willing to sell faster and harder into these rallies. So typically, those patterns continue. And so this is more likely. It's not a guarantee. There's just likelihoods. That's all technical analysis gives you. The likelihood is that this support line will break. Maybe not this time, maybe next time, or maybe will be this time. And then we'll go down to the next leg. And the next leg, what people do, and this is, sort of the self-fulfilling prophecy portion, is they do look back at previous supports, just because people like to make patterns out of things. So, we might see some support and at these lower levels. So we can get this straight. But you can see that on a percentage difference, these are almost equally far apart. But when you look at it on, there we go. Oops. There we go. So on a log, you can say that they're almost exactly evenly spaced, which is interesting. It looks a little bit more skewed on a linear chart. And yeah, so then we also see Fibonacci patterns, which are equally self-fulfilling prophecies as far as I'm concerned. But yeah, so the problem with that kind of analysis, like I was saying, is the cherry-picking nature of it that is simply done just to fit preconceived notions. It's not based on anything real. Because, like I said, we can look at this. I mean, this is, let's see, 7:15 all the way back to 6:12. So over a month, very tight range. And then we had that similar kind of range here. Or, if we like 2 months, why not? Let's go back to linear so it looks better. Why not this? At 7:50, we had 3 months there and another month there. So when you do technical analysis, it just has to be based in something, and that's why those kinds of cherry-picking analysis techniques are nonsense. I mean, it's a coin flip. Maybe you're right, maybe you're wrong, but you're not really stacking the probabilities in your favor, which is kind of the entire point of TA.